Past performance may not be indicative of future results. Therefore, no current or prospective client should assume that the future performance of any specific investment strategy, including the investments and/or investment strategies recommended and/or purchased by advisor, or product made reference to directly or indirectly, will be profitable. Different types of investment involve varying degrees of risk, and there can be no assurance that any specific investment will either be suitable or profitable for a client's investment portfolio. No client or prospective client should assume that any information presented serves as the receipt of or substitute for personalized investment advice from the advisor or any other investment professional.
Welcome to the Bullington Capital Report, hosted by Bill Bullington. For the next hour, you'll receive information on current market conditions and trends that could affect your financial future. If you have a question, you can participate in today's program by calling 216-901-0945. That's 216-901-0WHK. You can also reach Bill by going to his website, bullingtoncapital.com. And now, here's Bill Bullington.
Well, welcome back. It's always interesting, and it's, I don't know. I'm looking around at all the sources of information people have today. You've got the internet, you got cable television, and which is slowly merging with the internet. I don't know about you guys, but I've been using Google TV, or whatever they called it, as soon as it came out. And when I got it, it was $35 a month. Now it's $85 a month, and all the programming that was there is still there, and they've added to it significantly. But I can also watch it on my iPad or my laptop, and no matter where I go in the country. Kind of wild, but it's just it's amazing. Time goes on, and change happens, and it's always a pretty good thing. And in fact, that's one of the things I really wanted to talk a lot about over the next few weeks, really. Change is inevitable. And higher stock prices, pretty much inevitable. The problem with stocks is that they don't go in a straight line. And they don't even coincide oftentimes with the underlying company's growth. Well, the stock price doesn't necessarily coincide with that company's growth. And that's what gets really frustrating for an awful lot of investors is they think that, common sense would make you think that if the sales and profits were up by 15%, that business has grown 15% in value. The stock price should be up by 15%. You can toss a quarter on that. Actually, the quarter would be wrong. You don't have 50% odds. It's either going to be up a lot more than that, or it'll be down a lot more than that because somebody else is looking at and concentrating on 3 quarters from now when one of their biggest competitors is going to roll out a product that they think is going to take all the markets or take a lot of market share away from that company. And so in the short run, very frustrating. I mean, unbelievably frustrating. And you have to get accustomed to being frustrated if you're going to be a good stock market investor. You've got to get accustomed to watching the S&P go up and seeing that your funds are not going up at the same time. If you've done a good job of selecting them, they'll go up over time and probably even do a little bit, at least as well, maybe not better anymore. There's some other reasons for that. We'll get into that a little bit later in today's show. But why it's so difficult to outperform a market-weighted index, and that's basically what the S&P is. Market-weighted, all these terms, don't get intimidated by it. It just means they put more money in the bigger company. That's all it means. And that has this tendency to work really, really well until it doesn't. And that's one of those other things that you can't forecast with a high degree of accuracy is when that's going to stop working and when it's going to make you wish you'd never heard about stocks because that has a tendency to happen too. I'll give you an example. In March of 2000, valuations on stocks were at levels that they had never been seen before. by the way, they're slightly higher now today than they were then. But there's some other circumstances that are here. Anyway, make a long story short, stock prices were ahead of themselves, and I had started pulling back because you can't get that perfectly. There's no way to buy bottoms and sell tops. Anybody that tells you that either doesn't know any better or they don't want you to know any better because they're trying to sell you something. So one of the two, you just can't do it. And after all the years I've been in the business, I'm more convinced every year that I get older, and I'm pretty old now, that is harder and harder to do. So you can be a trend follower. That's different. I don't have time to go into that today. We'll do that on starting probably next week, because that's what an awful lot of these funds are doing now. They're just following trends, and it's a good idea. I mean, mathematically, it works out really well. And that's the one thing I really like about this particular market that we're in. You have a ton of really good tools out there. The problem is it takes a long time to read and watch and understand what the significance of a lot of those variables are. And I'll tell you the two most important, so I'm going to give you a cheat sheet. It's like Bill's Cliff Notes. Here are the Cliff Notes. The two factors that are going to matter most in a company's share price are how fast do they grow their sales, so sales growth. That's factor number one. Now, I'm talking about long-term, not over the next 18 months, because anything can happen during that time period. But in the long run, sales growth drives the company's value. The second thing is the profit margin. If you're growing your sales, but your profit margins are shrinking, that's a good way to go bankrupt. You do more sales making less and less money, eventually you're going into the red. And I've seen that happen a ton of times. And it's sad and unfortunate, but the companies that are able to grow their sales and maintain their profit margins, those are the ones that you want to focus on. And the ones whose profit margins are expanding, which happens occasionally, but not that often. Those are home runs. Those are stocks that will go up 10 or 15 fold, in a matter of 10 or 15 years. And I know everybody's disappointed now because I didn't say over the next 12 months. Well, good luck. And I've hit those in my career very rarely, and I knew it was rare when it happened, and I was following trends myself when I was doing that. And as I got older in the business and as computers became more prevalent in the investing space, those techniques eroded as to their effectiveness. They're still effective. They just don't work nearly as well as they used to. And some of the funds that are out there that are using those factors, sales growth, profitability, size, does it pay a dividend? If you can think of an idea, by the way, it's out there, good or bad. There are a bunch of really horrible ideas. I laugh all the time because you'll see them come out with these exchange-traded funds based on some new trend or some new feature like the crypto. Before that, there was the networking stocks because of the internet. And, those companies were making a lot of money. They were growing real fast. They didn't have any profit margins, though. And by the time they had gotten to a point where they were actually starting to grow profits, the sales growth started to slow down, and those stocks did horrible. So anyway, that's one of the reasons that broadly diversified indexes are kind of super popular, because they have a tendency to be in the top 10% of their categories, and it's pretty funny. But anyway, so if you're gonna look for companies to invest in or funds to invest in, this is one of the things that we do. We like to sit down and talk with our clients and kind of get an idea. Now, the vast majority of our clients will look at me and say, "Well, I thought that was your job," and it is. That's my job. But with us, we want your input. I like to listen and talk, and Most people are going to probably, I would say 8 out of 10 or 4 out of 5 people. Oh, yeah, that sounds good. And I try to get as broadly diversified as I can. If they like dividend-paying stocks, I'll limit the investment into non-dividend paying stocks, funds rather, and so that most of their funds will have dividends coming out. Then we get over into the fixed income side, the percentages. I've got a super simple, and I am so relieved, by the way. I have this financial planning software that I am studying. They've made an upgrade. Actually, they've made about 3 in the last year that made that very relevant for me in my practice. And it's going to take me a year. I mean, literally. It's going to take me a year to get up to speed on this. That's how complicated it is. But I think it's worth it. They've fixed some errors that I used to complain about a lot. It wasn't the company necessarily. It's the financial planning industry. And I don't have time to go into that on today's show, but just know that I'm working on a project. I'm nowhere near ready to roll it out. It's going to take a while, but it's really going to help. I mean, it's really going to help. And I'm excited about it. Hard to believe. I'm excited about something that, after doing business that I'm in for over 30 years. But I used to laugh when I was younger. I would say, hey, nothing is as constant as change. And boy, has that turned out to be true. I mean, things are just changing all the time. I guess there's the greatest wealth transfer in the history of the world is here in the United States. That's one of the other changes. People are waiting to have kids a little bit longer, so somebody in there, and that trend started back with my generation. They were putting it off. I wasn't part of that movement, by the way. I have 12 grandkids. So I started young, and they just kept going. But anyway, I just lost my whole train of thought there. That is hilarious. Yeah, so it's always the same, incidentally. These shows, after 30 years, I'm talking about the same subjects I've been talking about the entire time. It's just that, there weren't any exchange-traded funds when I first started this show. In fact, we were doing a lot of the stuff that I'm going to talk about in the second segment of today's show, individual stocks, and that was 90% of my business and 90% of all the business from most people that did what I did would do what I did for a living. Basically, I'm an investment advisor. Now we've moved into other areas. We're advising for retirement income. In the market itself, very little of the daily volume is done by individual investors. They just make up a super small part. I think that's kind of sad in a little way because, I've got Procter & Gamble, and I've done really well with it. And go look at Procter & Gamble over the last 6 years. That's probably that's about how long I've actually had that stock. And, yeah, it went way down when the market went way down. But you look at where it was 6 years ago and where it is today, pretty good. Yeah, look at it where it was back when the market crashed. And I think it's at 400% since then. And it pays a pretty decent dividend. And the thing is, I just like it. I like their products. They make Tide. They make Pampers. They make a ton of products. And I'm like, oh, when I first learned about this years ago, I was looking at all the products that they made. I'm like, I have half of those in my house. I literally have half of those in my house. Procter & Gamble is also in a lot of the ETFs that we hold. It's in a lot of ETFs because it's a big player. It's been successful. I really like this stock. Is it going to make you rich? I don't know. Maybe if you're 20. But for people who are 40, 50, it's a good company. It's probably going to add to some things, but you can get exposure to it through the funds that you own if you're owning the right fund. And I think that's probably a much better way of doing that these days. Just if you can dream of a strategy, by the way, it is out there. Somebody has got that strategy going. And because I'm telling you, there are more funds than there are stocks to invest in. And now there are almost more exchange-traded funds than there are stocks that you can invest in that are listed on a U.S. exchange and are big enough to be owned by a mutual fund. Now, if you want to get really granular and go super small, that stuff is super, super high risk. I'm not sure I would recommend that for the average investor these days. And I can't wait for the more of the facilities to start to open up. There's a little, looks like a little movie theater in the building that my business is located, and we're going to get that investment club going this summer, actually. And because I just like talking about this kind of stuff. It's fun. And if you're looking for similar things, everybody there is looking for us. A lot of them are trying to get rich quick. I gave that idea up a long time ago. Can you do very well? Yes, you can do extremely well. I don't think there's any other thing an investor who doesn't own their own business. If you're a business owner, well, you have an opportunity to make a whole lot more money. Most people, the top 5% of wage earners working for someone else, they can make a lot of money just investing their money in the stock market. And the rest of us, quite frankly, we don't have a choice. You don't have a choice. You've got to invest in stocks if you're going to acquire enough capital to be able to retire one day and not have to take a massive pay cut during your retirement years. And that's rough. If you're getting close to retirement, you got money in bonds, like regular bonds. You've seen what's happened to them over the past, probably 24 months. I've just been told I have about 60 seconds before I have to take a real quick commercial break. When we come back, we'll talk about alternatives to bonds, talk more about stocks. We'll go into a couple other topics. And right now I'm just going to take a commercial break. So this is Bill Bullington. I'm here right here on 1420 here every Saturday morning from 11 to noon. I'll be back after these commercial messages.
There's torn up pages in this book, words that
Hello, welcome back. This is Bill Bullington, and I'm here every Saturday morning from 11 to noon. If you guys would like to follow this on my website, there's actually a link, and you can listen to the shows after they've been broadcast if you feel like you missed something, or you can actually just call me. And my number is 330-664-0700. I'll answer the phone most of the time. If I am not answering the phone, it's because I'm doing something that I just can't get away from. So even on weekends and even at night. Yeah, so I really like what I do, and I feel very lucky to be able to do this for a living. So it's all good. And we're kind of talking about stocks and the economy in general. Economy's actually, you know what? I'm amazed at how strong it is relative to what I thought it would be. I mean, I thought we would have GDP would fall by, half. And it just hasn't happened. And wow, this is really a resilient economy. And the government's going to probably continue to raise interest rates. And that's kind of amazing that the debt ceiling's been a big deal over the past couple of weeks. I wouldn't, personally, I don't worry about that. I've seen this happen so many times. I mean, all the way back to 30 years ago, they were doing this. And every time it comes up, it's just another way for these guys, the lobbyists, to get their congressmen that they're supporting to go in and lobby some more for whatever those special interests are. And I'm not complaining about it because, you know what, that's actually part of the process. That's one of the reasons that the United States has done so well is because, you've got businesses out there who are talking to their politicians, and their politicians are trying to support their causes, which is what they're supposed to do. That's not an illegal thing. That's part of capitalism. And capitalism means competition, and competition brings out the best in everybody. It's brutal, but your alternatives are socialism. That's not cool. At least not as far as I'm concerned. Look at the socialist companies, and you don't have a chance in those countries. A bunch of my clients built successful businesses right here, and they put in an unbelievable amount of effort and work, and it took a lot of skill, some luck. A lot of them had a lot of bad luck and just stuck with it until it turned around. And those are the people I admire the most, because that is really tough to do. But anyway, long story short, if the debt, they don't pay, if they don't agree to this, and who knows, they'll probably bring it to the, down to the last seconds, they can go ahead and continue some government operations for a few weeks without passing the debt limit. But chances of that happening, I don't know. I don't think they're really, really that good, because after everything I've been watching over all these years, they like to make a lot of noise about it, and eventually they go, yeah, we can't really sacrifice the U.S. economy. We better get this done. So that's my feeling. I don't know, though. You've had so many things that are unexpected over the past few years. Some of the people that are holding office now, it's like, wow, that's amazing. That's a real test of the Constitution and people that are upholding it. And you know what? The people that wrote that, all those laws, all those years ago, a lot of people have a tendency to think, well, they weren't that smart. No, they were unbelievably smart. They were geniuses, and they also knew what oppression was. You want to find oppression? Go back in the 1400s and watch the kingdoms that used to fight each other all the time. Watch what kings used to do. That's oppression. So they had come through several hundred years of all that type of those lifestyles. They were telling you what religion you were going to do, or if you even had a religion, and how to live your lives. You're going to pay most of your money in taxes to the local king. And so all of this evolved from that, and it's amazing how far that it's all come. And what's even more amazing is how quickly they can report on things. And all of this stuff has been going on since this country formed, since it began, every country. And you just weren't able to follow it nearly as closely as you can now because of the Internet, because of technology. It brings everything right to the forefront. And I have news for you. Go back and read the, I think it's Thomas Register. I'll have to look it up again. I haven't looked at it in a long time because I've just been following the news stories or press releases that come out of the White House, and you get a synopsis of what's going on there. And if I really want to read something, if I'm really super bored, I'll get one of the laws that they passed, because they're only a couple thousand pages. That's the other thing that I just can't believe how long these new laws are. It's unreal. But that's the world we live in. So you just have to try to put up with it. Hopefully get some reliable sources of information out there. And like I was reading this one article, and this showed up in the Wall Street Journal. And the Journal, by the way, is probably my favorite news source. They're not always right, but they're pretty accurate most of the time. And the vast majority of the time, they're just telling us the way it is and just reporting on it. And in journalists, by the way, they're all supposed to do that. It's part of the journalistic oath. I'm just kidding. Actually, kind of. But yes, you're not supposed to, if you're working for a publicly produced paper, you're supposed to tell the truth. Okay, that's the bottom line. And so this article was when is the debt ceiling deadline, and what happens if the limit isn't raised? So if you'd like to see a copy of this article, just hit me up with an email. It's bill@bullingtoncapital.com. I can send it to you because I licensed it from this company. It allows me to send out articles that show up in the Journal and Barron's and a whole bunch of other publications. Anyway, this was good enough. I thought I might spend a little time reading it right from my computer screen. Anyway, it says the federal government could run out of money to pay its bills soon, putting Congress on the clock to again raise or suspend the federal borrowing limit. The Treasury Department said in January that the U.S. was bumping up against the current $31.4 trillion borrowing limit, prompting it to begin implementing so-called extraordinary measures to manage the government's cash flow through spring. Just to put this in context a little bit, the $31.4 trillion borrowing limit, they talk about that, and they don't. Most of the journalists don't give a lot of information about what that actually means, and I'm not going to spend a ton of time on it, but I am going to tell you that this is not the farthest it's been away. It's getting close. But the debt to GDP ratio was, actually it might be, now that I think about it, it's probably just a little bit further than it was after World War II. Now think about it. After World War II, okay? So during World War II, we had to, the government had to borrow a lot of money. It cost a lot of money to pack up a bunch of soldiers and send them overseas, and especially with tanks and rations and uniforms, ammunition. It's just crazy how much money gets spent. But so my point is, we've been here before, and I don't know how many of you realize, but after World War II and before we got into the Korean War, things were really booming. I mean, they boomed for 10 or 15 years. Yeah, so it's kind of interesting that big debt out there is the debt's a problem, but if you handle it well, then it's not going to be that much of a problem in the future. What is going to happen is you're going to continue to have inflation that gets higher than normal. And what is higher than normal? Well, the long-term average for inflation is actually between 4 and 5%. It depends on which time period you're looking back, but if you go back about 100 years, it's somewhere between 4 and 5%. So long-term fixed income interest rates, like for CDs in treasuries, used to be like 5%, 5 or 6%, and that was that way for an incredibly long time period. Those were the averages. They've been well above those averages. They've been well below those averages, but that's the average. So what I'm saying is we are just getting back to a period where things were considered to be average. Now, because things were so low, because GDP growth was low, because interest rates were low, and a lot of that didn't have anything to do with the demand here in the United States. There are pandemic wars going on. That's a little unusual. But bottom line is, this is nothing that we see now is kind of unexpected. And they've always, argued about raising the debt limit. And then eventually they go, okay, well, we got to do it. Yeah. Well, as soon as those key voters in Congress get whatever it is that their constituents are asking for, then it'll be passed and things will calm down for a while. Up until the next time we have got to do the same thing. So it's wash, rinse, and repeat, as far as I'm concerned. In the meantime, a lot of stocks have pretty good valuation. Why am I saying that? Well, I do these scans every day. I've gotten used to it. I don't spend a ton of time on it, but it doesn't take a whole lot of time. But I just like to see how strong the markets are and which sectors are moving. That's very helpful. Lately, when I'm looking at the valuations on the stock market in general, and I'm looking at the rates that you can get from a fixed index annuity that are guaranteed rates, the guarantee is only as good as the insurance company. They have restrictions on complete access to all of your principal, so they're not quite as liquid. But if you're looking for an income source, you're getting close to retirement when you might have to start tapping your retirement funds for income, you might want to give those a look. I think for a portion of your money, I think it's a very competitive, good idea right now. Okay, so I guess I've got a phone call. I forgot to give out the number. Well, I didn't give out as frequently. It's 216-901-0945, 216-901-0945. And I'm I'm not seeing the. Okay, so it's Jason. Jason, you're on the Bullington Capital Report.
Hey, Bill. Thanks for taking my call this morning.
No problem.
I said,
How are you?
So the thing I wanted to bring up was, I know you mentioned that the politicians are going to do what they want for the constituents, like try to get certain goodies or whatever, and I think that's normally the case when it comes to the budget. But in this case with the debt ceiling, the reason why, and I follow politics pretty close, the reason why you're having this problem is it's not because lobbyists or anybody are trying to get stuff in it. It's because you have a group of people within the House and the Senate to a certain degree that have said $32 trillion in debt is enough. If we continue down this path, we're going to be Rome and we're going to collapse. So what they're saying is basically the limit on the credit card is not going to get raised unless we put you on a payment plan to pay down your debt. Just like any American is not going to get, from any responsible credit card company, is not going to continue to keep their limit raised when their financial conditions start to deteriorate. So I think they're saying that unless you have drastic spending cuts, work requirements to make these people actually work and not have half the country not work, you're not going to get a debt ceiling raise. So I think that's the difference this time than in the 30 years in the past.
Right. Well, there's always been a large difference from time to time. I mean, the differences have been pretty incredible. But it's kind of like, in my personal opinion, it's kind of like, there are going to be differences in every instance. There aren't any two that are identical. So, but what you're looking at is cause. It's like you want to the general effect, not the exact effect. And the general effect, I think it's still, it's going to be pretty much the same as it's always been, but it's not going to be identical. And anybody that says that they know how this is going to play out either doesn't know any better or they don't want you to know any better, because there are no other options. There are so many things that they can do, and which ones they're going to, I've been surprised a ton of times. And I remember way back to being in college and having these discussions with my economics professors, and they're like, "Yeah, it's never the same." And but there are certain things like it's like gravity. If you jump off of a 3-story building onto a cement sidewalk, you're probably going to get hurt. You don't have to be exact to know that. You know what I'm saying?
Right. And I don't think anybody has a reasonable understanding of how money works and that and credit and everything. I don't think they would advocate that you default on debt.
No.
I think what they're saying is that you have to, but just like a kid, if a kid is continuing to do something that is dangerous for their well-being, which continuing to spend money at the levels that we are is dangerous to the health. You have to put some type of safeguards and say, okay, we're going to take care of what we've already spent, but there are limits for this to continue, and we have to get back to something that's more sustainable. So we have a country for the future, right?
Yeah, that's exactly how I felt when I was in my 40s. I mean, exactly. It's like you and I are probably related. And then I see these knuckleheads continue to do what they're doing today over and over and over. So I'm wondering, when is that day of reckoning actually going to come?
I think no one knows. No one knows for sure, but I can tell you, you start to get a feeling, and you start to look at things, and you say it can't go on for a whole lot longer.
Well, here's what was really funny for me. I was thinking I absolutely, I know where you're coming from. I walked around for 10 years with a whole lot of stress, thinking this is it. Oh, I got to take a quick break here. Do you want to hang on, or did you want to?
You know what? I'm going to listen. I'm going to hang up and listen to your story. I appreciate you taking my call, Bill.
Thanks. So thanks for calling. And
Okay, thanks.
appreciate that. For the rest of the listeners, we'll be back right after these commercial messages. Thank you. Well, welcome back. This is Bill Bullington. I'm here every Saturday morning from 11 to noon. If you'd like to set up a phone call to talk about your own situation or just ask me questions, feel free to go to my website. That's bullingtoncapital.com. You can find our contact info there. And this is what I really love to do more than anything else in the world. So don't worry about bothering me. You are never a bother. It's fascinating. And so that last call was a really good call. And I know people think about that a lot. And it's tough. You know, investing is not easy. Looking at economics, economics is known as the dismal science around the world, because there's always something new changing that slightly changes the whole picture and sometimes leads to an unexpected result. And that's why it's so frustrating, by the way. Stock market's the same way. But you can still navigate. You don't have to know exactly what's going to happen. I mean, think about it. If you had to know exactly what the weather was going to be before you took a flight, you know how many flights would get canceled? A lot. Or, any transportation for that matter. So if you're trying to wait for things to be perfect, you're probably going to have a big problem. You're going to have to learn how to navigate. Like airplane can go around a storm, so you're going to adjust. You're going to adjust your path to fit the circumstances that you're confronted with. So same thing with financial stuff. And right now, if you're in a place where you're within, say, 10 years of actually retiring, the fixed income portion, I just want to make sure I get this out. Bonds, as interest rates go higher, bonds are probably going down. They've been down a lot over the past couple of years. I'm just amazed when I look at the average bond fund. We were holding this super short-term bond fund, and it's down a little bit, not a lot. If you had reinvested all of your income from it, you're still fine. You actually get a profit. But the bond market, holy cow, just looking at the aggregate bond index, I've never seen it drop like that. I mean, it's still down 18.75% from where it peaked 3 years ago. I mean, that's mind-boggling. I haven't seen that in a really long time. So I think that if you're looking at individual bonds, that's okay. CDs, that's okay. They're going to be short-term. If rates keep going higher, then maybe you'll luck out and be able to get higher rates. I would use a fund that's relatively short-term right now and is managed, or I would use a fixed indexed annuity. When I look at the guaranteed interest rates on those things, then because interest rates have been rising, they've been increasing the interest rates on those, which is kind of a good thing. And those are kind of the ones where you just set it and forget it. Most things financial are not like that, so that's a little bit more relieving. The interest rates that you're going to get, they're typically somewhere between 1% to 2% higher than what most CDs are. They're tax deferred. If you're not taking it, if you're not taking income, then don't take the income stream. And that's something that's really important. The income stream is not the same as interest. We'll talk about that right after I take this phone caller. And sorry, but my computer just went out, so I don't know who's calling. Yeah. Okay. So
yeah, Bill.
Well, yes. How are you?
Okay. A couple of things I wanted to just put another point of view on the debt ceiling right now.
Yep.
This is politics right now. The debt has been high for so long, and even Powell, the head of the Federal Reserve, said that you address the deficit over decades and when times are better. It's not something that's going to be cured overnight,
Right.
And, to put the economy at risk, they're going to get something done. This is just, negotiating,
Yeah,
and
I know. I just wish they weren't so heavy-handed.
Yeah,
it's crazy.
and the media loves this. They want to, this is a countdown to event, which the media wants. This is, they want to dramatize everything, but this is all going to be settled. And again, you don't take a huge debt like we have and cure it overnight. It's going to be done over decades.
Right.
And,
right. Exactly.
The other comment I wanted to make, excuse me, is can you do a show in the future possibly on the next big thing when it comes to investing or, products or whatever?
Yeah, actually, I was going to do that today, and then I talk so much like I normally do that I don't have time to go through it that much. But next big things typically will show up in stocks that are running really fast right now. And so I'm just looking at one, which I think is really funny, IDT Communications. I've known that company for a really long time, and it's been incredibly volatile, and but they do basically telecommunications. And if you know what there was a pattern that a trading pattern that it was really made popular. Cup and handle, yeah. William O'Neill. It's formed a cup and handle, and it just broke above the handle. If that makes any sense to anybody, I don't put a lot of weight into this. I look at all of it as math, and mathematically, almost all the funds I use are run by formulas. It's math. There's no human involvement in it, and they've done way better than the ones run by human, and they've beaten me, doggone it. But when you're doing what I'm doing, that's to be expected. Actually, when you're doing what anybody's doing, it's going to be expected. Over time, you're not going to win all the time. That's just not going to happen. If you know what you are looking for, then you can. It's a lot easier to get done. If you've got a disciplined strategy, it's easier to get done. And it's funny, I was also just reviewing like magic formula investing, and here's something I would tell you. If you want to pick stocks, go to magicformulainvesting.com, pick from that list. The guy's name is Joel Greenblatt. When he wrote his first book, this guy was a hedge fund manager. He had a phenomenal track record. He's super wealthy. I think he was a Yale graduate, but he went to Columbia to teach because that's where Warren Buffett's mentor, Ben Graham, taught. And he didn't need the money anyway. But the book that he's got that I think is a key read for anybody that's interested in financial markets is the little book that beat the market, or a little book that still beats the market. And it is a little book. It's like a 5x6. It's tiny. And it's only a couple hundred pages. You probably will have to, if you're brand new to this, you're probably going to have to go to Investopedia to look up some of the definitions. But if you're not brand new, you'll read that in a few hours, maybe an hour if you're really a fast reader. But and it lays out all the fundamentals of everything that you need to know to be a successful stock investor. And then he put up this website so you can go in and screen using the criteria that he talked about for the stocks that he liked to put in his portfolios when he was running the hedge fund. He's advocating that you hold a lot more stocks than most people do, and he didn't do that with the hedge fund. Those guys only held 10 to 12 stocks. They looked really, really, really deeply into those companies, and they were willing to ride the volatility. The volatility when you do something like that is huge. So he doesn't recommend doing that for everybody, and neither would I. But anyway, it gives us a lot of stuff to talk about.
Can I make one thing? We hear about the electric cars being the next big thing. Here's a technology that I've overlooked. I just read about this. Time, how you keep time. That is going to possibly change over from quartz that keeps time now to semiconductor chips. And people should be on guard for that. You're going to have a big revolution in how time is kept in all your electrical devices.
Huh. I didn't. I'll have to look that up. I didn't see anything about
There's
that.
There's a company called C-Time, and it's the leader now. I'm not recommending the stock, but I'm just saying that that's one of the really big revolutions in the future. They have technology that makes GPS 25 times more accurate and reliable.
Wow.
So, yeah, that's incredible. I read that and I go, this is mind-boggling. And they said that time has been kept by quartz technology, and that there's going to be a gradual shift to this technology, which is more reliable, more durable. So, keep that in mind for the next big thing.
Yeah, I will. And the way I typically find out about it is I'll see a stock that comes up on a screen that looks interesting to me. Then I start reading about the financial statements. What do they do? That kind of stuff. But I like to see stocks are moving before I start to buy them. And so I'm going to keep my eyes open for that, because that sounds interesting. By the way, Qualcomm was the big pusher. They were responsible for most of the GPS in the world. And that stock was one of my all-time. It was huge for me. It really helped my career big time. And because I did what you're talking about doing, I was looking at, this stock went from $350 million in revenue 1 year to $600 million, and then to $1.2 billion. They are 900 and then to $1.2 billion. No one had ever done that in that short of a time period before. And so I get exactly what you're saying, and I just wish I had as much time as I did back then just to kind of look into that sort of stuff. But hopefully for the next few months, should be actually the next few years. But anyway, thanks for calling. That was a really good. Those are good observations, and really helps the show. But I can't hear him anymore. I guess he might still be there. But anyway, so, okay. All right. I got about 1 minute left here. So if you've heard anything, you want more information on those fixed annuities right now, by the way, the interest rates on the income, depending on your age, the older you get, the higher they get. They start like off in the sixes, and then they go higher depending on how old you are. So if you have a question and want to see what that might be for you, just go to my website, or you can just call me, 330-664-0700. And I've got to run right now. Have a good weekend, everybody. Good luck. Good investing. All right. Hey, thanks. Hey. Okay, have a good weekend. I'll send over the PayPal money.
Just caught another edition of the Bullington Capital Report, broadcasting every Saturday at 11 a.m. on AM 1420, The Answer. If you have a question and you'd like to speak to Bill personally, you can call him at 330-664-0700. That's 330-664-0700. Or online at bullingtoncapital.com. That's bullingtoncapital.com.
The preceding program has been paid for by Bullington Capital Management, LLC.